Hi and welcome back to the channel. I hope everybody's doing well out there. I've got a company here, it's a UK based tech company which has really perked my ears up within the last few weeks or so. Looking at this share price on the screen, when you see anything that's down 50% over the course of 1 year, you're thinking to yourself, what the heck is going on here? Is this company in turmoil? Is it in capitulation? Has revenue been slashed? What is going on to make this go down 50% within 1 year? Market cap right now is about 178 million, so it's a low market cap. It's quite a small company in the grand scheme of things. The PE ratio is sitting at about 17, although when we look into this a bit further, it's probably sitting at closer to 11. And it's got a very good, strong dividend yield of 4.3%, which is based on last year's payment. So if this can remain the same, you would get a very strong dividend yield. Now, as I said, you look at this 52-week chart and you're thinking, what is going on? It's only went one way over the last year, and that is down. But if I can throw up the maximum chart, you can see that over a long period of time, this stock has been a real high performer, and it's probably made a lot of people a lot of money out there. So what's the script? Is this company dead in the ground, or could this potentially be a good turnaround play? And we'll have a look just now into who Iomart are and what they do. Iomart was founded in 1998 as an integrated internet and telecoms company. But as an online services started to take off, it was clear that their customers needed additional support. In the year 2000, they floated on the London Stock Exchange, providing a range of cloud services to businesses and public sector organisations. In 2007, they decided to buy their first UK data centre, which combined with their 2,500 kilometre of dark fibre network, allowed them to independently manage their customers' entire online journey. Their customers continued to grow, and they also built up extra expertise through the acquisition and joining forces with some fantastic specialist brands operating throughout the UK. And the bit I've got highlighted here at the bottom, most recently in 2020, their founder, Angus McSween, stepped down and Rhys Donovan became their new CEO. Rhys has introduced some fresh ideas and he's added some new team members to drive the next chapter for Iomart. They're focused on putting their people first, building a learning culture and working hard to develop exceptional service to their customers by making things straightforward. Iomart, I've actually had a few personal experience with them. I work within the telecoms industry within the UK, mainly within their Glasgow site, which is a data centre. And this is what they do. They offer IT managed services as a sort of cloud-based company. But if we go back to the share chart for just a moment, between October and up to April time, the share chart was going up and down. It was just consolidating. It was going sideways. It hadn't had a clear direction of which way it was wanting to go. The 7th of April comes around and it has an initial sell-off, and from there it came back up a little bit. It tested just above that resistance line, but then it came back down and it's just been down a downward trend ever since then. Even more so, the 1st of October, so just over a week ago, there was some more news about the company which has come out, and this has further sparked a huge sell-off in the stock with a really steep decline. So these two dates over the course of the last year have been very instrumental in how the share price has been moving. So let's take a little look in to these specific two dates and see if we can work out what is going on with this company. If we jump into here, we can see the Iomart. We're looking at the Iomart share chart just now, looking over some company information, and this is on the Hargreaves Lansdown website, which is currently the broker that I use at the moment. So the two dates that we said, these are both appear here in the company news section. So we'll go look into the 7th of April to see what firstly they were saying back in April, and will bring us up to speed looking at October. They're saying they offer continued stable financial performance in the second half of the year up to the 31st of March, despite the UK's third COVID-19 lockdown. So they're saying, yeah, everything were fine, but this is where it starts to go pear-shaped. At the lower end of the expectations, that's where they see their full year results ending up. And of course, we know that if there's anything lower than what's expected, 9 times out of 10, it means the share price is going to go down. However, what they're saying is that the company remains strongly profitable, and it was confident that it had a strong basis for growth once the UK business confidence returns. The group itself reported revenue of 112 million, which is pretty flat year over year compared to last year's 112.6 million. Underlying earnings of roughly 41.5 million were down 2 million year over year, and pre-tax profits were also down about 2.8 million. So they're saying here that the company has got stable financial performance, but the outlook back then was going to be on that lower end of the spectrum. So let's have a little fast forward. We'll jump up to October, and this is the reason for the big sell-off here. They're warning on profits, and they've got higher than usual customer churn, meaning that more customers are leaving on their non-recurring revenue streams. Iomart expects to report revenues of approximately 52 million for the first half, down from 56.3 a year earlier, with adjusted underlying earnings dropping to 19.5 from 20.8, and adjusted pre-tax profits slipping to approximately 9 million from 9.8. So everything is going down. Now these revenues, when you look at them, they're only down between 5 and 10%, if that. So for the share price to come down 50 odd percent over the year, it might be overdone, and it could possibly mean that the company's undervalued. One of the positive things we've got here again is that revenues remain stable, with recurring revenues in the period accounting for 93% of the revenue. So 93% of the revenue is recurring, part of their annual revenue, which is strong. That's what you want. It's a subscription-based model, and where they're losing their money is from their individual customers who are leaving. This may be small companies, and these small companies just aren't willing to invest in their IT infrastructure at this current time due to a bit of uncertainty. And just to finish off this section, they're saying, as a consequence, the board anticipates results for the full year of the 31st of March 2022 being below current expectations. To end on a more positive note of this section, the CEO, Rhys Donovan, is saying they're on track to achieve key milestones in their strategic refresh, which we laid out in May for delivery of full year 2022. Their team is energised behind a new brand and a vision to attract and retain quality customers. Sales, operational and organisational improvements continue to be made at a vital scale to the business. They're starting to see signs that the market is responding to their newly launched offerings. While these successes will take time to flow into their financial results, they provide solid foundations to support their growth. If we take a little trip through the company's financial statements, we can reflect back on statements from up to 2017 through to 2021. So we've got 5 years information right in front of our eyes here. 90 million, up to 97, down to 103, 112 and 111 million. So revenue hasn't been totally decimated. It's been pretty slow and steady. Same when you look at the profit before tax. This has come down quite a bit, but it's been quite consistent. 14, the higher end of 14, 16, up to almost 17, and it has come down quite considerably over the last 12 months, which could be why that big sell-off in the stock. If we scan down, earnings per share has gradually been pretty decent. It's been performing well, and you'll get a cheeky little dividend here. As we said, that's sitting at 4.36% yield just now, and it's been quite consistent in regards to being between 6 pence up to 7 pence 50 almost there, and back down to £7.10. And the company do have a dividend policy, which will just fire up in the screen here just now, where they're looking to pay out between 40 to 50% of their earnings per share going forward. Balance sheet is absolutely fine. If we check out how much cash they've got at the bank, that's been from 2017, they've been adding cash, which is good. It means they're in a healthy position. Even though the revenue might be down here or there, they've still got plenty of cash on hand to cover this, as well as possibly looking out to further merger and acquisition opportunities out there in the UK data centre market. Total assets also been going up from 143 million to 230 million, which is good to see. And liabilities has also been grinding itself up a little bit, but net assets, it's never had a bigger difference than what it has been. So the balance sheet looks good. Financial statements do paint a bit of a gloomy picture in regards to the profit before tax, slight income coming down, but does this merit a 50% sell-off? That ultimately is the question within the stock. This is the new CEO here, Rhys Donovan. Rhys has over 23 years experience in the technology and telecommunications industry. He joined Iomart as the COO in March 2020, and he took over as the CEO in October 2020. So he's had quite a turbulent time in regards to where the share price has been. Could this be an additional reason why the share price is so depleted, that the market doesn't have faith that this new guy on the block is going to cut the mustard? But if that is one of your reasons, there could be a bit of comfort here. You've still got good old Angus. He's still kicking about on a non-executive director, and he was of course the founder back in December 1998, and he's retired as of October 2020, so he's had a year with his feet up, but he still remains on the board as a non-executive director, so he still has a part to play within the company. If we have a look at the market forecasts here in comparison to how the performance has been, 2022, as expected, is to be one of the worst years. It's gone back to 2019 levels in regards of a lot of performance. Net sales is expected to be similar to 2019. EBITDA is to be the worst out of a long time, alongside other things such as earnings per share. also expected to be towards the bottom end. So the market thinks the company is going to be doing as it has done. It's going to be slow and steady, very consistent, not a lot up, not a lot down as well. And I think this is what makes it a very interesting buy. And this is the section here which makes the stock very interesting in my opinion. The bit I've got highlighted mentions, this is straight from the CEO's report, and he's mentioning that within this presentation it's concluded with an aspiration that the company is to become a £200 million revenue business within the 5 years and be recognised as a leading secure hybrid cloud business. So that's very contradicting to what the analysts are expecting. They're only expecting it to 2024 to still be sitting around that 110 million. But the CEO has got optimistic plans of being £200 million in revenue in the next 5 years, and that's which can make this a really interesting stock. If they can pull that off, this will be a huge turnaround play, but really there's so much up in the air. Revenue just now is down, and it's hard to be that optimistic about the company. If the CEO can pull this one off, then that would be a huge turnaround for the stock in the company. I've got here on the screen the UK data centre market trends forecast out to 2026, and what they're saying here is that it's expected to grow at a combined annual growth rate of 5.5% out to 2026. So the growth forecasts are pretty consistent and stable, and the section there at the very bottom, if we look at that, according to a survey conducted by the firm DLA Piper in December 2019, the UK is expected to acquire a lot of attention from equity investors. Also, according to the data economy reported by Digital Realty, by 2025, UK-based data centres would be responsible for the storage of data with over $135 billion annually. These instances showcase the positive outlook for the market within the region. With Iomart's low valuation, could one of these large data centre REITs from the US or abroad come in and purchase Iomart? That could be a question we need to ask ourselves here. Just to round off the video, we'll have a quick look going through where analysts are seeing this stock price. Out of the 5 analysts on Market Screener, they're giving it an average price target of £3.11, which would give you a current return of 91.3%. We've also got a low price target of £1.30, which would give you a negative return. So out of these 5 analysts, you've got 3 buys, 1 hold, 1 sell, and 1 without an opinion. And you can see, if we look over in the far right corner, how things, mainly since April, which is when these first negative earnings first get released, how these sell signs have started to come in place. So let me know what you think. Have you heard about this company? Is this your first time hearing about Iomart? Do you think they have the potential to be a turnaround play? Would love to know any of your thoughts in the comments sections below, and I'll catch you in the next video. Cheers.